Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to go over velocity banking again, with a special emphasis on the first lien HELOC. And I've made several videos like this before. And I feel like there's not really that many YouTube channels really doing the math on the first lien HELOC, right? And I actually got a comment about this about a month ago. And this is why I make these videos because I've gotten emails of people wanting to replace their low interest rate mortgage, and I've had at least 2 people email me, about this, and, they were considered doing it, and again, I just do the math, you decide for yourself, but someone wrote this comment, and it kinda is heartbreaking about, how they would probably need to spend more money than necessary because they did get a first lien HELOC, but I'm gonna read the comment for you, just give me one moment.
Okay, so I've watched a few of your videos, and I can't disagree with your math. Unfortunately, I'm someone who replaced my low 2.5% interest mortgage with a first lien HELOC at around 8% to pay off high interest debt. It's not the worst decision since I'm practicing velocity banking, but as you've pointed out in your videos, I'll end up paying more interest this way. I wish I'd seen your advice about getting a second lien HELOC and chunking at the mortgage instead, but here we are. My question is, what should I do now? Refinancing into a 30-year mortgage isn't an option with today's high rates, so what's the best course of action?
Did you see that? The AI corrected his grammar. Uh-oh. We're, uh, we're headed toward the Skynet phase where they're gonna try to correct us. That's not good. But anyways, so, yeah, I mean, I've done the math over and over again, and I just wanna show you the math, and you judge for yourself, right? And, I don't have any advice for this person because, like, I've done the math so many times, like, I don't even know what I would do if I found out I had to pay hundreds of thousands of dollars more than necessary, with a first lien HELOC than a second lien HELOC. And if you don't know what velocity banking, first lien, second lien is, I'll just give a quick explanation. So all velocity banking is throwing all your money at debt with the help of a line of credit, right? And there's various ways to go around it about it. I've seen it on YouTube where people are saying that a first lien HELOC is like the best thing since sliced bread and everybody should do it. And so if they have a 2.5% mortgage, why not replace it with the 8% HELOC? And I think anybody with a noggin can kind of be like, "Huh, that doesn't make sense." And you should say that, right? Like you should question things. In fact, you should question me as well, right? I don't mind if anybody tells me I'm wrong. I'll just respond, "Folks, you're not part of the cult." That's how irrationally respond. But you should do the math and you shouldn't trust me from the beginning, right? And so all a first lien HELOC is a replacement of all your debt at like a higher interest rate, like 8%, including your mortgage, right? You're replacing your mortgage and let's say your house is worth about 600,000, they'll give you like 800, I'm sorry, not 800, 80% of the 600. And so maybe like a 400 or $500,000 credit card limit, kind of like that. But they'll replace your mortgage and all of your debt. You will kind of be like at 8%. That's what a first lien HELOC is. I actually have a first lien HELOC, okay? So believe it or not, this is my $280,000 first lien HELOC, and the way that I did it is I paid off my mortgage first, and then I got the HELOC. Therefore, it's first lien, meaning that there's no other debt, right? But what the internet is kind of promoting, and I'm kind of like, I don't know if cringing is the right word, is replace your low interest debt with a HELOC. And I'm going to tell you, just from my understanding, why that may probably is not the best idea. Okay, so there we can do it one of two ways: first lien or second lien. So first lien means replace this 2.5% mortgage, and second lien is like, yeah, get a second line of credit, but your mortgage $300,000 2.5% mortgage is still there. That's all that is, right? So again, let's actually just start from the beginning. What is velocity banking? Basically, all it is a debt payoff strategy where you throw all your money at debt with the help of a line of credit. And all a line of credit is a financial tool where you could borrow money, pay it back, and then use it over and over again. Okay. So here's what I think is like the most neglected part of velocity banking, which is what is the order which you pay off debt? To say that someone should pay off their $300,000 2.5% mortgage is kind of a little bit crazy, and saying that they should replace with the 8% line of credit. Like again, I've done the math so many times that I just kind of know that you're going to overpay by $100,000. And here's the thing. If you're watching this video, right, and you're consider doing it and almost signing the application, and you're like, whoa, 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 like, oh my goodness, like, well, I was going to overpay by $100,000. Click the Google form link below. Um, you might want to think about purchasing a Renatus education. It actually costs about $20,000, and you might be like, "Whoa, $20,000!" And here's the crazy thing: you were considering paying over $100,000 in interest than necessary, but when I talk about education that could potentially expand your wealth and also help you save more money, you wouldn't consider it. I think you would. Click the Google form link below. Just a plug. All right. So this is what we're going to do today. We're going to do both scenarios, which we've done before. And let me go back to the cash flow index thing that I was talking about right here. So, what is this? Basically, it's a formula of you take the balance of the debt and you divide it by the minimum payment, and you get this arbitrary number here. Okay. And you take a look at this one, it's very, very big. According to the cash flow index model, you want to pay off the smallest um, number. So think of it as a ranking system. And what does this small number mean compared to the big number? Well, the small number means is that if you pay off the debt, you get a lot more bang for your buck. That's what this small number means. So, for example, you take a look at this 253 number with the 30-year mortgage. So I'm going to show you, give a quick example. Would you pay off this $35,000 of debt to get $1,100 back in your cash flow? Or would you pay off $300,000 of your debt to get $1,100 of your cash flow? Obviously, you're going to pay off $35,000 to get $1,100 because you simply get more bang for your buck. And so, because we get so little cash flow, um, when we pay off the mortgage, this is why we don't want to immediately pay it off and we want to leave it for last, right? So the cash flow index model supports that we should pay this off last and focus on these other debts first, right? And as you can see, it's not a coincidence that these credit cards have these low cash flow index, and we focus on that first, then the auto loan, and then the student loan, right? But according to people on the internet, and again, I'm not as popular as those people on the internet. I'm not, but it's okay. It's okay. Being popular has nothing to do with being right. I don't know if you knew that or not, but being popular has nothing to do with being right, and I don't care if I'm popular. But what's that song? You know, if loving you so wrong, I don't want to be right. It's okay. It's okay. You can love me. I'll be right. All right. So let's go ahead and do this. And to set velocity banking up, you just kind of copy the expenses, and then you don't have any savings, but you have this thing called cash flow. And I'm going to assume that you kind of know the basic strategy here. So I'm going to skip some parts and make it easy to kind of do. Like I'm not going to go over everything, but you move your debt into line of credit, paycheck in, expenses out. But here's the thing, okay? We have to calculate the cost of the line of credit interest, which we're going to do, right? So let's go ahead and sum up all the debt. And I believe if I did this correctly, so credit card, actually the credit, this is probably from a previous demonstration. Let me just do this again. So let's figure out how much credit card debt we have: 5, 8, 15, 27, 37, 10, 30, 35, 25, um, 50, 300. So let's calculate the amount of debt that we have. So $512,000 of total debt. And let me just calculate how much credit card debt we have. So delete, delete, delete. $137,000 of credit card debt. Okay, so remember these numbers. All right, so now let's go ahead and do the what we call the first lien HELOC. So let's imagine that we have a home that's worth a lot, right? So usually, the way that the home equity line of credit works is they take the value of your home, multiply it by or subtract the debt tied to your home, and then multiply it by 80%, 80 or 90%. That's how much they allow you to borrow. But with the first lien HELOC, because you're going to replace all your debt, they don't really subtract what your current debt tied to the home is. Hopefully that makes sense. And if it doesn't, we'll just assume that we have a huge line of credit available to us, right? Just assume that. Okay. So what's going to happen is that we're basically moving all of our debt. So obviously, when we move this high interest debt there, it's an obvious win. But is it an obvious win when we include the auto loan, the student loan, and the low 2.5% mortgage? That's something that we always have to do the math with, right? And sometimes the math ain't so obvious. That's why we do the math, right? And so now let me go down here, and this is going to be $512,000 of debt 512000, right? And so we do that, and guess what? They all go to zero. These payments all go to zero when we do a first lien HELOC. And so now, if we take a look here, you might be like, whoa, all these payments are gone, $7,000 of cash flow. But we kind of calculate the interest of the line of credit a little bit separately. All right. So the interest, because it's variable, and again, we're going to have to put our entire paycheck into the line of credit, expenses out, and then the cash flow is about 7,000. But that's before calculating the interest costs of the line of credit. So let's go ahead and do this, and then we're going to calculate the previous month's balance plus the previous month's interest minus our cash flow. Okay. And so let me go ahead and do this right here. And if you want to calculate the average daily balance, well, there's an average function somewhere. This one right here, average, multiply it by the interest rate, 0.08, and then divide it by 12, right? Because that's how we calculate the monthly interest. And as you can see here, we have $7,000. But then, it's not really $7,000 of cash flow because the interest cost is so high. So it's more like $3,000, right? So again, at least we're positive. That's a good thing, right? We're positive. All right. So now let me go ahead and do this. And we're just going to copy and paste and then figure out how long it takes to pay off that the whatchamacallit, the line of credit. And so it's going to be around 101 months, right? So let me highlight this right here. And so 101 months, and how much interest are we paying? Hold on. Whoops. Yeah, I screwed up here. All right. So now let's do this. 188K. So about 101 months. Let me do this. 101 months. I don't like that font. 101 months and 188K. Whoopsie, not 99 of interest. Okay. So let's go ahead and go back up here and write down our results under first lien HELOC replacement, right? We're replacing all of our debt with the 8% line of credit. Okay. Now, see, it's very easy to calculate, right? And let me just kind of go back here and how much is 101 months? About 8.4 years. Okay. I mean, that's not bad. 8.4 years. But the thing that gets me is the $188,000 in interest. So it's like, ugh, right? Like that's a no bueno. That's a no bono. I think that's how they call it in Italy, in Italy, Italia. Ever watch those like YouTube videos about like my Italian husband? Man, makes me want to have an Italian husband. Kind of, but not really. All right, so let's go ahead and do this. And all right, so now we've easily calculated the what happens with the first lien HELOC. Now let's do the second lien HELOC and then use the cash flow index to figure out how to properly pay off the debt. Okay. Easiest way to figure out pay off the debt is the cash flow index. Garrett Gunderson, you are a genius. I'm going to say that because I remember the first time somebody sent me their debts and it was like, I don't know if it was like 15 or 20 debts. And I was like, how do you get rid of this? And I was like, oh, cash flow index. That's so easy, right? That's the easiest way to figure out which debts to pay off with the line of credit. So let's go ahead and do it the right way. Okay. So this is what we're going to do. I'm going to recopy this. And what we're gonna do is we don't need a $600,000 line of credit, to be honest. I mean, we don't. But I'm just gonna move the credit cards. We'll maybe say it's like $150,000 line of credit. It doesn't matter. But we're gonna start off with the credit cards first. Okay, let's start off with the credit cards. So these are 8 credit cards. Look at these low cash flow index numbers like 20 and 30. And then we're not going to include the auto loan because the auto loan's a 50, right? Let's wait on that. Let's do the 20 and 30s first, right? And so now that's $137,000 of credit card debt, 137,000. So let's move this 137,000 right here, and then guess what happens to these payments? 0, 0, 0, 0, 0, 0, 0. And then now let's kind of redo the formulas again. Let's do it again. And this is G2 plus H2 minus 4799.12. And then what we're going to do is take the average daily balance and multiply it by the interest rate, which is 0.08, divided by 12. Again, same formula, but look at this. I mean, look how little interest we pay when doing this. Oh my goodness. 3,000 versus like 897. And let's see how fast we can get rid of that credit card debt. So simple. So simple. You know, back when I was a kid, and this is just a random story, nobody really knew the difference between Chinese, Korean, and Japanese. And when I used to play video games, I always thought it was so funny to hear people making fun of like the Asian accent. And like, I never really get offended with that, but I feel like people are so like uptight these days that nobody can make fun of each other because there used to be a game called like Shadow Warrior, and this is like a random tangent. But if you played PC games back in the day, people were they didn't get offended, and I never got offended too. Shadow Warrior. Now, why am I talking about this? Because I just think it's funny how no one can, make fun of whatever nowadays. And I'm gonna play like the clip from it. Give me one moment. And also, remember, this game is not safe for work, so don't, like, look for it because it's really probably really offensive nowadays, but let me just quickly play it.
Ancient Chinese secret.
That used to make me laugh when you find the secret in the game, it goes, "Ancient Chinese secret." Man, I wish it doesn't when you say ancient Korean secret, it really doesn't sound as good, but I'm not Chinese, so but, someone did ask me on a Zoom call, "Are you really Korean?" And I was like, "I don't know, I might just be like a white dude trying to invoke feelings of Mr. Miyagi, but the Korean version of it, so I can make my YouTube dough." You know what I mean? What if I actually did do that? That would be crazy. Anyways, let's go ahead. Enough of the random chit chat. Okay. So as you can see here, it takes about 33 months to get rid of 32 or 33 months to get, we'll say 32, right? So let's just do this. Okay. We'll mark this right here and we'll say 32 months to get rid of the credit card debt. And I'm going to sum this all up and see how much interest we pay. So this is about 14.8K of interest. Okay. So 32 right here. And let me just do this. All right. So now, if you know how this works, then we take on the next debts and we have to kind of figure out what the current balance of the next debts are, which is at 32 months. And luckily I have this awesome loan calculum jigger to figure out the current balance of the loan. So I just do 32, 32, 32. And then you see that it's in my best interest to move this 12 grand to get the $460 of cash flow back. The 26 cash flow index is an indicator of that. So I'm gonna do that and move the 12 grand in the whatchamacallit. I don't even know what I'm saying. All right, so now, so let's move this 12 grand, 12288.72 into the line of credit. Okay. And then what's our new cash flow? So let me go ahead and zoom out right here. Well, basically, this auto loan goes to zero, right? Hopefully, you can see that. But sometimes it's a trade off because YouTube doesn't, the screen is small. And I don't even know how you all watch it. If you watch on mobile, I'm really impressed. Because, like, who watches someone doing Excel and math sheets on mobile? I don't know. It'd be really hard for me, but yeah, this is our cash flow. So, all right, so I'm going to do this. we're going to copy and paste. And then I'm going to copy and paste here. And our new cash flow is 5259.53. Okay. And I'm going to copy and paste. Whoopsie, I screwed up here. All right. So, ooh, look at that. In about 2 months, right? So that's crazy. So let's go ahead and copy this, and I'm going to sum up the interest here. So this is like negligible interest, you know? So $116 of interest, and this is how we calculate the loan interest, okay? So what we do is we add the total interest that's accumulated here, because we that's what the calculator does. Whoopsie. And then we also add these two up. So it'd be like 2.1 grand, right? So let's just go ahead and just do this equals J2 plus K2. And then so 2.1 grand. Okay, you see that? So I'm going to go back here and put in a note that the car loan is 2.1K of interest. And how many months? That was like 35 months in total. So at month 35. Okay. All right. So 35. So not that bad, right? So 35 months. And I need to actually write what it's for. So CC completed at 32 months. And then the car, all right, 35. And then here we're gonna do the next one, which is the student loan. So this is now 0, this is now 35, 35. And then as you can see here, the cash flow index is almost 70, right? So it's not a very low number, because if we pay off the 35 grand and it's a high interest, I'm not a lower interest rate than the line of credit, we want to be a little bit careful. Safest way, okay, just as a rule of thumb, you don't have to really understand this, to pay off low interest rate loans with the higher interest rate line of credit is use a chunking, what we call the chunking method, which is just split the loan into pieces and moving into a line of credit. And so, again, I won't go over the explanation today, but luckily we have a velocity banking calculator to help us figure out what the how long it'll take us to pay off the debt. So what I got to do is I just got to fill it in, right? So I'm just going to do this right here. And quick plug, this is a Renatus Velocity Banking Calculator, what's I originally learned velocity banking from. So when I first learned it, I don't think when I took the classes, they said, oh, always put your um, line of credit over a loan. In fact, the instructor Randall said that that the loan and the line of credit interest are calculated the same pretty much, right? And that, you know, the terms simple and compound don't really they don't really apply to debt as much as they apply to growth and savings accounts, right? That's why I learned all about this. So if you're interested in learning not only about velocity banking, but also about financial literacy, real estate investing, click the Google form link below. Again, that's my quick plug. I do get commission when you buy, again, lifetime education from me. All right, so let's go ahead and plug this all in, and this is going to be, what's the original $50,000 balance? That's the student loan. What's the current balance? It's 38361.75. 38361.75. What's the interest rate? 6 and 10. So I'm going to just do that, 6, 10, and then this is going to be 555.1. 555.1. And it's going to be 8%. Oopsie, 8% interest rate. What is my income? What is my income? It is $9,000. $9,000. Okay. Income is 9,000. My expenses are everything except for the loan I'm trying to pay off. So it actually would be these two. So it's 3185.36. So let me just do that right here. 3185.36, because this loan payment is included right here. So now let's go ahead and put in the new line of credit chunk amount. It's just a small amount. We just do 9,000, should be fine. And then right here, wablam, 0.6 years and $768 of interest. So let me go ahead and put this right here. Okay. So I'm going to put, what is it? 768.77, 768.77, and let's go ahead and calculate the total interest, which is 8559.11. Okay, so I know I might be going a little bit too fast, but don't worry, you can trust me. You can trust me, I think, or maybe I'm just a random a stranger on the internet who's not even Korean, teaching you the ancient Chinese secret. Ancient Korean secret doesn't sound as good as ancient Chinese secret. Do you all know where that phrase is from? I think it's from like a cleaning commercial for cleaning products, like back in the 70s. I forgot what it was called though, but I can't remember off the top of my head. But let's go ahead and put the student loan right here. Student loan, and this is gonna be we'll say 8.6K, be a little bit conservative in the estimate. 8.6K. Okay, and how many months? Well, that's basically 0 0.6 plus 35. So 35 plus 0 0.6 times 12, and that's, we'll say 43 months. Okay, 43 months. All right. Now, the next one is essentially the mortgage. Okay, the mortgage. And we just do the chunking thing with the mortgage again. Again, with the low interest rate, you don't want to move it into a line of credit because now this whole 300 or whatever is in the 8%. So it's like kind of going from a 200-degree oven to a 400-degree oven with your turkey, right? But the thing is, the reason why we can use like an 8% line of credit is kind of like, even though you're going to a 400-degree oven, it's like you're opening that oven every 5 minutes. That's why the chunking method, like that's my best analogy for the chunking method, right? Like, yeah, it's a 400-degree oven, it's 8%, but you're opening that oven every 5 minutes or so, so no big deal, right? Now the interest rate does matter, but it doesn't really matter. But if you put it in a first lien HELOC, that's like putting the whole turkey in the 8%, or I'm sorry, the 400-degree oven, and then wondering why like it's so juicy and cooking, right? That's why we don't put that mortgage into that first lien HELOC. 3%, actually this should be 2.5. What am I doing? I mean, the math is still correct, but I still want to make it right. Okay. So let's go ahead and do this. And all I need to do is fill in the numbers. And what month are we in? We're in month 43. So 43, right? So I just got to fill it in again. So let's just do this. 2.5, 30, 30. This one is gone. This is gone, right? And then this one is just now $2,000. What's my original balance? 30000. What's my current balance? It is 274,819.57. 274,819.57. And then the payment amount, okay, the payment amount is 1185.36. 1185.36. And let's see here. What is, am I forgetting anything? Nope. 3.5 years. So 3.5 years and 13.5 grand. Okay. So 13524.77. So let me go ahead and add that here. 13524.77 is the interest. Okay. So now what we do is we just get that. And so we paid about 39.3 grand in interest. So let me go ahead and do this. So 39.3, and then this one is going to be the mortgage. Okay. And how long did it take? Whoopsie. How long did it take? It took 3.5 years. So what we do is we add 3.5 to the 43 months. So 43, we could do it in years now. I think we can do it in years. So 43 divided by 12 plus 3.5. 7.08 years. 7.08 years, right? And now let's just kind of do a final comparison. So 101 divided by 12, that's all right. So now let's just do this. So it's 8.41 year, 41 or 41 years versus 7.08 years. Okay. Now let's do the interest. So it's 188K, right? Versus, let's Drum roll, please. 14.8 plus 2.1 plus 8.6 plus 39.3. 63, and we'll just do this. We'll round up. 64K of interest. And so how much time do we, so this is the first lien HELOC. So how much time do we save? Well, it's 8.41 minus 7.08, right? So 1.33 years we save, right? So 1.33 years saved if you go with the second lien HELOC. And this is, again, this is the crazy part, okay? So how much do we save in interest? So not just time, but interest. 124K of interest. Folks, if I saved you $124,000 because you originally had a low interest rate mortgage and you were thinking about doing a first lien HELOC, you kind of owe me if you didn't already do this, right? So I'm guilt tripping you into the $20,000 educational package. And again, that's only if you want to, because I don't really need the money. But if you do purchase it, think about me. Think about, I want to say the children, but obviously this has nothing to do with children. But, you know, they always say in those commercials, think about the children, right? Think about the children. All right. Well, yeah. So again, as you can see, this is why I have the imagery of the money burning, because it's like, well, you would have, if you did this, you would have paid $124,000 more than you would have had to. And how much is a Tesla? How much is a Tesla? Is it 50 grand? So that's like, I don't know, 2.5 Teslas. Could make a sitcom about it. Call it like yeah, remember that sitcom 2.5 Men? Well, it's like the same thing, 2.5 Teslas. I don't know what you do with half a Tesla, but you could buy me a Tesla if you want, if you don't want to buy an educational package off of me. Okay. All right. Well, that's it. I know I shouldn't be laughing because you know, some of you actually did do this and probably are devastated to know that you probably paid a lot more doing a first lien HELOC than you would have to. And if you just use a second lien HELOC, then you probably would have been a little, you know, better off doing that, right? 7.08 years, but it's this $124,000 of interest that you don't have to pay that really gets you, you know? Again, I'm not making fun of you. It's just I started making these videos once I saw these other velocity banking videos. Like, oh, that ain't right. I don't think that's right. Got to do the math. And again, here's the way that I see it. Right, when the bank calculates your statements and all that, they don't use a whiteboard. Use Excel. And if you have no idea how Excel works, it's okay. We make mistakes. Do it over and over again. Okay. That's why I get so good at this stuff. And some of you are like, I go so fast because like I'm like Neo in the Matrix. Well, think about how many videos I've made in this YouTube channel. In fact, I'll just show you right here. Ooh, 10, this one didn't do that well. Okay. How many videos do I have on this YouTube channel? I will show you if I can get it up in the dashboard correctly. Go to videos, and no, I'm going to the wrong place. Okay, but you see I made 812 videos, 812. Remember that rule about 10,000 hours and Bruce Lee saying, I fear not the man who does 10,000 types of kicks once, but one kick 10,000 times? That's what you got to do to get better. And I will eventually get to 10,000 kicks. I just don't know when. And once I get to 10,000 kicks, well, what does Tyrone Magnus always say? Journey to 1 million subs or 10 million subs. We'll see when we get there, right? All right. Well, that's it for today. This is Korean Atlanta Mentorship. If you're interested in not only learning about velocity banking, but also other things, real estate investing, financial literacy, click the Google form link below. Click below. Okay. Have a great day, and we'll speak next time.